We have talked about balance sheet. Now let's look at cash flow statement. What does cash flow statement report? Cash flow statement report a company's cash receipts and cash disbursement during a particular reporting period. So as you can see here that the difference here, cash flow statement is also a flow statement. So it reports a firm's cash receipt and cash payment during a reporting period. It is for a period of time versus balance sheet. If you still remember, it is to report a company's financial position at a point in time. Why do we need cash flow statement? So there are several reasons we need a cash flow statement. First of all, income statement is not enough because it is based on, for income statement, it is based on accrual accounting. And there are limitations to accrual accounting because accrual accounting is subject to subjective judgment. So it is based on accrual accounting, as we mentioned in the previous class. Accrual accounting involves estimates. And the problem with estimation is it can either be subjective to unintentional errors or intentional manipulation. And also cash flow can provide insight into the validity and sustainability of accrued net income. So which just means that cash flow statement can be a good addition to income statement. And also the last reason is if you are debtor, debtors want cash because they want because they need to be paid back in cash. So debtors want cash. They want to see how much cash flow the firm has and whether the firm has enough cash flow to repay its debt. Format of a cash flow statement. Cash flow statement includes 3 sections. The first is cash flow from operating activities. The second is cash flow from investing activities and cash flow from financing activities. And within cash flow from operating activities, we usually have 2 methods to report it. One is called direct method and the other is called indirect method. And one thing to pay attention here is no matter direct method or indirect method, for your cash flow from investing activity and cash flow from financing activity session, those 2 sessions are exactly the same. The only difference for those 2 methods is only in the cash flow from operating activities session. So let's first look at cash flow from operating activities. This session is basically a company's cash-based revenue and expense, or it's another version of the firm's income statement, just on a cash basis. So that is inflows and outflows of cash that result from activities reported in the income statement. In other words, it's just the firm's income statement of a cash version of a firm's income statement. And then cash flow from operating activities. We have 2 approaches for cash flow from investing activities. One is direct method, the other is indirect method, as we just mentioned. Which approach is more commonly used by companies? The answer is indirect method. About 99% of the firm use indirect method. And why is indirect method more common? Because it relies exclusively on available data. So it's just easier to make than the direct method, and which we're going to see later when we talk in more detail about those 2 methods. So cash flow from investing activities. We just talked about cash flow from operating activities. Now it's cash flow from investing activities. Cash flow from investing activities are inflows and outflows of cash that result from investing activities of a company. Examples are purchase and sales of PP&E. So if a firm purchases PP&E, purchase our equipment, that's an investing activity. If the firm sells that equipment, that's also an investing activity. Purchase and sale of investing assets. except those classified as cash equivalent and trading securities. Why? Because those two items, those are current assets. So if it is classified as trading securities, that's actually an operating activity of the firm. Look at change on long-term asset. So a rule of thumb here is we have a balance sheet. The left-hand side of the balance sheet is asset. And within asset, we have current asset and long-term asset. The right-hand side of the balance sheet is liabilities and shareholders' equities. Within liabilities, we have current liabilities and long-term liabilities. And then we have shareholders' equity. So a rule of thumb here is for any item that is clarified as current asset or current liability, those are usually operating related. If it is classified as long-term asset, that's usually investing related. If it is classified as long-term liability or shareholders' equity, that's usually financing related. So that is the rule of thumb. And then let's look at cash flow from financing activity. Those are inflows and outflows of cash that result from external financing activities of a company. Examples are issuance of stocks or bonds, dividend payment, share buyback, borrowing or repayment of the amount borrowed. And then we look at change on long-term liabilities and equity.